Hi, and welcome to our LinkedIn Live special edition on the release of ISM Spring Semiannual Economic Forecast. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication, and we're excited to have you with us today. The Semiannual Economic Forecast is based on responses from the Manufacturing and Services Business Survey Committees that help compile the monthly ISM report on business. It reports recent sector performance based on purchasing and supply executives on the front lines of the U.S. economy, as well as their sentiments for the rest of the year. Manufacturing and services executives still expect growth in production, employment, capital investment, and revenues for the rest of 2024, but it's certainly not gangbusters, and in many cases below projections from December 2023. And like we do for the monthly manufacturing PMI and services PMI broadcasts, we'll get the insights on the semi-annual economic forecast straight from the sources. So I'm pleased to be joined by Tim Fiore. He's the chair of the ISM Manufacturing Business Survey Committee, and Anthony Nieves, the chair of the ISM Services Business Survey Committee. And guys, I guess the main bullet points for this report is that familiar phrase, cautious optimism. I have a lot of questions, as you know I do every month, but I'd like to give you guys an opportunity to kind of give your summary of what the manufacturing and services data said for the semi-annual. And so, Tim, we'll start with you on the manufacturing side.
Okay, thanks, Dan. Thanks, Tony. So, yeah, exactly right. Less optimism in May here compared to December for sure, but we're much better aligned with what's been reported on the PMIs month to month. So, I think what we've been reporting is slow growth. We believe we're in an expansion cycle, but it's weak. And, we thought we'd hang somewhere between 49 and 52. And that's kind of what this forecast update is really saying. So, for instance, sorry, our revenue estimations for 2024 are now revised to 2.1%. That's up from 2023's 0.9%. So we're growing faster than we were in 2023. 2023 was not a growth year. On the manufacturing side, it was a contraction year. But we're growing nonetheless. But that's more than half less than what we thought we would see in terms of revenue growth. Our revenue projections, I think, were 5.5. So, and the other thing I want to point out here is that when we did the forecast in December, we did not have the benefit of Chairman Powell's statements on December 15th. That he really said three important things. First thing is that there's no intention of raising rates in 2024. Basically, in December, he said we're at the peak now. The second thing he said was we expect to cut rates in 2024. The assumption was probably late spring, then it turned to midsummer. Now it's late fall, and we'll see. And the third thing that he said was we don't really expect to get to 2% inflation until sometime in 2026, which kind of says that we got plenty of time to get there and expect bumps. So we've had bumps in the last 3 or 4 months. I mean, we went over 50 in the month of February. Over March, we dropped below 50 in the month of April, 49 and some change. We're hanging around the same spot, weak growth. So along with that says that we really don't expect to have a lot of investment this year either. And I'll talk a little bit about CapEx, production capacity, operating efficiency. That fits very well with an unknown future. I mean, I think we do know that we do not expect rates to go up this year, which is definitely positive. But we don't know when rates will cut, and that was really a tailwind for us because this whole forecast was based on no assumptions on the Fed interest rate side at all. But I think what you're seeing here is businesses being cautious. Last year was a liquidity year. This year should be a profit year. Profitability so far has been pretty good, but obviously they're paying attention to liquidity, and I'll talk about that. So the second thing here is that operating efficiencies are basically the same that they've been since December of last year and since May of last year. So our operating output has not gone up at all, and we've been basically, tense. So we're basically managing headcount and factory floor space to maintain a fairly low level of operating efficiency. We would expect during the peak periods, we're closer to 90%. And we're sitting now at 83.8%. And that's been the number. The second thing is we don't expect to expand our production capacity as much as we had thought. So right now we're forecasting a 2.4% production expansion capacity. When we started the year, we thought it would be 7.8. Now, look, some of these comps are difficult because we had dramatic double-digit numbers in 22, 23, based on what had happened the prior year. These comps really are not that good. In looking at the forecast update here, it's kind of clear that we're mirroring two other prior years. 2016, the beginning of the Obama-Trump expansion cycle that ended in the summer of 2019. We saw that expansion start in April of 2016. By the end of 2016, it was still relatively weak. This is about that same level. And then in December 2019, these are similar numbers to December 29. We were already in the pandemic. We late summer 19, the end of the year, and the pandemic obviously threw us into a nosedive. But we were at the end of it. So this looks a lot like the beginning of the 2016, 2019 expansion cycle, or the end of the 2019 cycle. So, nonetheless, I think we're still in a good way here. It's just not as optimistic as we were in December. The other number here, CapEx, 1% growth, down from a significant 11.9% projection, almost 15% growth in CapEx last year. But again, another tough comp because we couldn't get what we wanted in 2022. So a lot of that carried over into 2023. So I think the summary is that you're going to see a subdued amount of growth for the balance of the year. The community is saying that we are growing compared to 2023. We're performing better. That revenue growth at 2.1% is, like I said, compared to a 0.9% growth in 2023. So we're growing nonetheless. And I think the last thing here is on the employment side. Going into the year, we thought we'd expand employment by 2%. We thought we had dropped employment in the second half of the year by almost 1.6%, I think the number was. So we kind of thought we were going to get back to where we were at the beginning of 2023. But now the feeling is definitely subdued. 0.3% growth in employment from 2023 versus the end of the year 2024. But that's up compared to a minus 0.6% in 2023. So overall, we've lost the optimism of December. We've been weighing on, the inflation numbers, and that I think that's kind of the key number here at the end is the inflation number, which is kind of good news. I think if you're looking at when is inflation going to stop, we're going to get back to normal. Right now, we're predicting a 1.9% price growth in 2024 compared to 2023, of which we've already seen 1.6%. So the community is saying that we've already seen the price pressures so far this year. We'll see additional price pressures, but they'll be a lot less than what we face in the first 6 months. And by the time we get to the end of the year, our price position from what we were paying in 2023 versus what we're going to pay in December 2024 is going to be less than 2%, which I think is a really good number.
Yeah. I have a specific question on inflation. We'll talk a little bit about that later. I know that's on a lot of our viewers' mind. But hey, Tony, just give us the read on the services sector.
Well, I wish I could just get away by saying ditto, but that won't work.
Yeah.
But anyway, it's interesting how when you look at the manufacturing sector and, having been involved with the ROB for as long as I have, and it's unbelievable that as the years go on, how much closer and how they parallel each other as far as the two sectors. And especially when you look at the percentage composition, contribution to GDP, yet manufacturing is just such a barometer as to what is really the environmental scan of what's going on in the economy. And it's so true when you look back, back to 2016, right, and where things were going, and we were dealing with things such as the trade embargo and all these other types of variables that were impacting the economy. And yet it was so resilient and so strong in that latter part and going into those years right up until we hit the pandemic, right? And the pandemic, as Tim said, everything fell off the cliff. It took a while for it was like a lag of about a month on the services side, especially when we were doing and not to get into the specifics of it, but the data collection and the timing of the release and when the reports came out back then. And we were just really stumbling for a number of months. And then we came into that pent up demand and it was off to the races right after that, coming out, strong demand, We shortage of workers getting back into the workforce, wage pressure, pricing power, all that was hitting us all at the same time. And yet the services sector was resilient and had some, gains and growth. And then as we saw last December of 2022, we hit contraction, right? So we hit contraction, and that was unforeseen by many, but we rebounded in 1 month. Now here we are again last month. We went into contractionary territory for the services sector. Time will tell if this is just another blip on the screen, but when we look at the semi-annual forecast in totality, same thing as what's being predicted on the manufacturing side. Mm-hmm. Soft economy, soft growth. Fortunately, we've had, this steady incremental growth, even with the contraction last month, translates into an annualized basis of, 0.2 on the 0.02 on the GDP growth, but still, 2% on the GDP growth. But anyway, it's still a lot of uneasiness out there as it relates to things such as inflation. And, Tim hit a very good point. When the Fed said that they were looking at rate cuts, yet we have not had the ability to stave off inflation. Yes, margins have been good out there, but yet revenue has been relatively flat. When we look at the summation of things for the services sector, looking at the operating rate, definitely a slight improvement from where we were from December of 23, but yet we've been operating at high rates prior to that, over 90 percentile, and then we pulled back to 86.5, and now we're up to 88.6. So you look at capacity, similar situation. It's half of what we saw predicted in 4.1 in December 23, and now down to 2.6. So it's kind of where things are a little bit less optimistic than they were previously. Prices continue to be strong. Certain commodities have fallen off on the monthly list that we've seen. I mentioned that on the call earlier today, but the same old culprits remain out there, especially in food category. Capital expenditures, I always like to say that there's two things that influence service companies when it comes to capital expenditures. We saw an increase in capital expenditures during the pandemic because companies says, okay, let's use this lull in activity to improve our product and services for when we come out of this. They were feeling optimistic. Now, as we get into the period of time, and less so than what you look on the manufacturing side as far as availability of product, raw materials, this is more about confidence, right? So reinvestment is such where I used the analogy earlier today about keeping your powder dry in a storm. So we're seeing that capital is not as robust as it has been in the past. And then on the labor front, I always said, as employment goes, that's how this sector goes. It's a labor intensive sector, and we're looking flat. I mean, employment is again not being pessimistic about it. It's just what it is. It's like looking at it of less than 1% increase, 0.8. It's just not a good story for this sector. But again, not to be gloom and doom here, we're still experiencing growth. It's slow incremental growth. We feel that our respondents feel that this will continue into the balance of 2024 compared to how they felt, back in December, where they figured that the second half would be better than the first half. That doesn't seem to pan out here. But hopefully things get aligned and we'll see where it goes from there.
Yeah, both of you alluded to it. That was a question that I had in your opening comments that, a lot of focus is going to be on some of the raw data that we've seen for the first few months of the year that were below expectations that the survey committee had in December of 2023. But also you both pointed out that in a lot of cases, the figures, there's year-over-year growth there. So I guess my question is, if you're putting this on a scale, which one, should be a little bit lower? Which one would you say is more important right now to put the focus on when you look at the overall landscape?
So I think I think the best way to look at this thing is the 2016, 2017 growth cycle. I mean, if we're looking now like we looked back then we can look at 2016, 2017 and see how the year evolved. So, for instance, in December of 2016, we were operating at about 82%. We're now at 83.8. By the time we ended the year, we were at 86%. That's a pretty good step up. And it wasn't a dramatic growth cycle. It was a natural demand supply growth cycle. I mean, it wasn't until the end of 2017 where we had stimulus, and the stimulus was really the Tax Cut and Jobs Act, as we talked about earlier. If you look at, let's take CapEx. We projected 2017 a CapEx growth of 0.2%, essentially none. By the time we got to the end of the year, 4.3%. We grew in 2017 with another forecast at 2.7% for 2018. So we could very well see the same thing in this case. This is a really good, if you're an interest rate watcher, Fed watcher, this is a good forecast. This is good. You're slowing the rate of growth, which was, and we were presenting a counter argument that said that we were going to have a dramatic level of growth in 2024 before interest rates were even talked about being capped out or cut. We had projected a 5.6% revenue growth without any tailwind help from the Fed. So, and then, the big number here, obviously, and employment, we had projected a 2% growth in employment in 2024. We're now down to low single, tenths, which is almost, in the forecasting era we're talking about here, it's zero. So we're not going to be hiring people in 2024, which is another good news story for the Fed, because they're trying to cap the employment. They're trying to dance this middle line, as you know, and they're starting to talk more and more now about touch and go, no real landing. And then the most important, the hottest thing that Tony and I are dealing with these days is what's the price number? What's the price number? Now, contrary to some of the other indexes that are out there that when they report prices are also reporting labor costs, their own labor costs, we don't do that. We report purchase material prices. And we're showing that by the end of the year, we're going to have less than a 2% growth in purchase material prices, PPI. That's a good number. That's a very positive. So if we can stick on this forecast through the end of 2024, we're in a good way. I mean, it kind of says that all the policy and things, even in spite of all the stimulus that's been thrown, there's more stimulus coming. We know that. The Inflation Reduction Act with all the green energy credits going in, the infrastructure bill, the armaments that are coming through, that's inflationary. If we can deal with all that and still bring these numbers home, we're in a pretty good way. This is probably the listeners who have been listening to some of my forecasts in the past. We generally have an expansion cycle of 28 to 34 months. And the last one didn't last that long. The one before that, I think, was about 30, 32. That's the one we're talking about here, 2016 to 2019. This is going to be a slow grow out. So it's going to probably be a longer expansion cycle, because I don't see us peaking either like we peaked in the post-pandemic expansion where we spent so much time over 60. I don't know what would do that without some huge amount of money flowing into the economy, which I just don't see. Yeah. So this is probably going to be a longer growth cycle, but it's probably not going to be as hot as we saw post-pandemic, and even to some extent in that 17 to 19 expansion, 16 to 19.
Tony?
Well, I hate to say, keep echoing Tim, but he's spot on with his takeaway on this. And I think that, when you look at the services sector overall and what's been going on, and prices have been strong, and yet we've seen a little bit of tapering off in most of the commodity areas outside of the food arena. I think that, we still have the same usual suspects. I mentioned that earlier in the call. And as the inflation stabilizes, and Tim's spot on with the employment picture, because if you look at what the Fed manages, right, they're managing, besides the monetary policy, they have to deal with unemployment, right, and the interest rates and keeping the economy going. But they basically only have three basic core things that they manage. And with staving off inflation and then the hiring being stagnant, I think I've heard Tim say this a number of times on monthly calls about how that's not a bad thing when it comes to, managing the interest rates, right? So
Mhm.
overall, I'm hoping that we do see some interest rate cuts. And the reason why I say that is let's look at what is the number one contributor to GDP in the country right now, right?
Mhm.
Real
Real
estate,
estate.
rental, and leasing.
Mhm.
They've been hammered, right? And it depends, again, it does vary geographically, but that sector drives a lot. It's just from sheer dollar volume of a transaction compared to the one-off stuff we see in other industries, right? Someone who just is selling a home could be, and especially in Southern California where I'm at, the median price of a home exceeds a lot of other areas in the country. So you look at those rates and the commissions and everything else that come into play, and commercial side. I mean, commercial real estate has been dead in certain areas of the country. So leasing has remained, rental and leasing has actually been fairly strong depending on the market. But again, not to go off on a tangent here, I think in perspective, when you look at overall this sector, we do need those rate cuts to stimulate economic growth. I'm not trying to act like I'm the Fed policymaker here, but
Mhm.
it's a fact, and that inflation hopefully will stabilize. I think that we're getting some, how would you say, influence from what's going on globally in the supply chain, as far as certain areas of where we've had lagging deliveries due to what's going on over in the Middle East, as well as we know the Panama Canal has been affected. Domestically, we had issues with Key Bridge. I mean, it's just on and on. I think if we can get past logistical challenges as well as geopolitical concerns, hopefully things get settled sooner rather than later. New election cycle we got going on here. I'd like to see some stimulus in the economy so that this sector can definitely start seeing some growth rather than this slow and steady and even this decline that we experience month over month.
Yeah, that's a good, Tony. I should have just asked you the question that I had on inflation there because you answered a big part of it. I mean, one of the things that stood out to me when I looked at the prices number is that the respondents in both sectors, the increases that they reported for the first 4 or 5 months of the year, they were below what was projected in December. And you probably, I know you saw we had a positive, considered to be positive CPI report today. I mean, is that a sign that maybe the worst is behind us on inflation?
Yeah, but it's tough to say because look what's
Yeah.
factored into CPI and what isn't factored into CPI, right? And one of the things
Mhm.
I keep highlighting, look at what food and energy are still very
Mhm.
costly right now, right? And their spikes are huge, especially out where I'm at. I don't want to say that California is his own country out here, but it feels like it
Mhm.
sometimes, especially when you look at price points, right? Cost of fuel, cost of energy, cost of food, it's way off the charts compared to other areas of the country, but it still follows the same trend of increases. So, I mean, we need to get that channeled, and so that CPI number, in my mind, is a bit misleading
Okay.
compared to what is the total picture as it relates to cost.
Mhm. Well, yeah, that leads a good question for you, Tim. You discussed it earlier today, and we've discussed it a lot on monthly calls, where it's just the waiting game for demand to come back, and that leads us to one of the special questions. You know, most of the respondents answered affirmatively that the demand that they've seen so far has either met expectations or exceeded expectations. Now, that could be a product of modest expectations, but it's positive nonetheless. And then there was another special question where a lot of the respondents expected supply chain performance to improve in Q3 and Q4. So just talk about those dynamics, especially if the signs continue to be good and we get prices relief.
Yeah, yeah. Thanks, Dan. So I'm warming up to this forecast more and more because I think this
Uh-huh.
really fits. And Tony's comment here about food and beverage. That's why we didn't hit 50 last month in the
Mm-hmm.
PMI. Our food and beverage sector sagged pretty dramatically and surprisingly. So, and I'm not really sure what's driving that. We're going to see. I'm anxious to see what happens here in May. I'm expecting it to bounce back. I mean, we're in season for the food guys. So
Mm-hmm.
why do we see such a dip But I think there was an anomaly. I think we're going to see it come back, which means we're going to be above 50, which I'm hopeful that we're going to see. But we had 32% of manufacturing respondents say that demand is not meeting their expectations. That was significantly higher than what I think it was 20% or something back in December. So the expectation, going back to December forecast, very optimistic. 4 or 5 months later, not as optimistic. Demand has not met expectations. So, okay, what's going to bring that? What's going to bring that demand back hot? I don't see anything in the near term without significant interest rate cuts, which probably we're not going to see to the end of sometime in 2025. In the meantime, we're going to have a fairly good, high quality, non-dramatic, non-news making growth. And there's nothing wrong with that. We don't have a ton of people unemployed. We have to get this inflation number under control. It's really difficult to be arguing with your suppliers every day about how much more you should pay or how much discount you should be getting, because it's a zero-sum game, and there's no winners, there's lots of losers in this. So, I mean, the positive thing is industry is still making money. That's good. They're being cautious about investments. That's okay. I mean, they can turn that back on in the fall. We're running off of bad comps because of the pandemic. I think we've cleared the pandemic cycle now, and this thing is looking a lot like the 2016 to 2019 growth profile, which eventually built up some pretty good steam and carried right through to the middle of 2019. So, I love the fact that we're not going to expand on the hiring side. I think that's really good. That means we're going to make sure that we are liquid and we're profitable. And I like the fact that we're not going to overextend ourselves on CapEx that right now we don't need when we're only operating at 83%. And I like the fact that we believe that over 80% of our price growth has already been experienced. Therefore, we're kind of at the top, 0.3, not a huge deal through the end of the year. And then we'll know in December what 2025 looks like. So this really fits well with the PMI, very well. The forecast of December was very optimistic. We scratched our heads and said, where's this coming from without interest rate cuts? This is like, okay, we're sick of this. We're going to grow again. Well, it didn't kind of pan out. That's fine. This forecast 2.0, December was forecast 1.0, forecast 2.0 is saying, hey, we're going to do okay here. We're going to be fine. We're better than 2023. We're growing in the first half. The feeling has always been second half will be better. We don't ask that question this time around, but there's definitely a feeling that second half will be better. And we're expecting demand to be better than it is today. Hopefully it'll come back in a few months.
Yeah, that's a good recap looking forward for manufacturing. We're coming down to the bottom of the hour here. So Tony, I'll give you the last word just as we go forward in services for the rest of the year, anything that we haven't talked about or anything that you'd like to add in regards to the forecast.
Well, I'd like to add that, we talk about profit margins and percentages and all that, but in services industry, you don't put percentages in the bank, you put dollars in the bank. And, when it comes to demand, and Tim hit on it, that demand has to come back, because at the end of the day, revenue hides a multitude of sins. All right. And we need the revenue and we need the top line, and bottom line's great, but that's what we count on, but it's not the percentage, it's the dollars. And so we need to see that revenue and top line and bottom line both increase, and not just on the percentage sake, because you can only go so far controlling your expenses. And that key expense for services is labor. And what does that do? It's a vicious cycle. So, let's go cheer on the demand side, right?
Yeah. Well, hey guys, that was great. A nice little, 30-minute encapsulation of, why I enjoy talking to you guys every month and why I learned so much, on not only on our report on business, but, just what it means for the overall economy. And that was great. Thanks again. And thanks to you for joining us today. For more information, go to ismworld.org, where in a little bit you can read our article that details a lot of what Tim and Tony and I have discussed here. And if you'd like to be a part of the ISM manufacturing services or hospital business survey committees that help compile data for the report on business, visit ismworld.org/join the panel for more information. It takes just a few minutes to respond each month. So join us for another LinkedIn live session on June 3, when Tim and I will break down the manufacturing PMI numbers for May. So for Tim Fiore, Tony Nieves, and some good folks who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name is Dan Zeiger, and we'll see you next time.